So welcome. We've been missing everybody. We haven't had a show in a couple of weeks, so we're really excited to come back, and we're coming back really strong with Vance Barse joining us today. So it will just a quick round of introductions. I'm Cynthia Murphy, head of research for the ETF think tank. I will let Dan and David speak for themselves, and then Vance, if you can round it out and give us a quick intro of who you are and what you do. So Dan, I'll pass it to you.
Me, Dan Weisskopf here, ETF professor. I've got to change my background, so I'll join you guys in the bar. Also lead ETF think tank person and member of the investment committee at Turoso, as well as co-PM on Block. I'm rambling. David, you're up.
How's it going, everyone? David Shikansky here, portfolio manager with Turoso Investments as well. I work on the SoFi Gig Economy ETF and the IWIN Inflation Fighting ETF, which obviously is very prevalent in today's conversation. Should be a really interesting show. Vance, I'm going to kick it off to you. Let's dive right in. Tell us who you are, what you're doing, and maybe some intro thoughts on where we are today.
Sure. Well, first and foremost, thank you very much for having me. It is truly a pleasure to be here, fresh off of the ETF conference circuit. I spent 10 years of my life traveling the country full-time, teaching financial advisors how to invest for their clients with a very specific type of investments that historically have hedged downside risk. And it was interesting to me because much of this environment reminds me of the legs down in 2008. But in any event, I spent that time raising money for well-known institutional names like John Paulson, SAC, Brevin Howard, Citadel, Winton, and others. And I became, I would say, disenfranchised and disillusioned with much of what I learned in that decade of spending time inside of financial institutions. So I opened up my own firm. It's called Your Dedicated Fiduciary. We have an office in San Diego and one in Prosper, Texas, which is north of Dallas. And we are very happy to serve as the in-house advisor for all planning strategies and investments for 54, soon to be 55 families around the country.
So Vance, before we get into the nitty gritty, I guess we might as well just start with the elephant in the room, which is the last 24 hours, or maybe since Monday, the whole, is it 50, is it 75? And the market tanked and the market recovered and the market tanked again. So are you really bullish? Are you really bearish? I mean, how are you feeling about just the general market setup right now?
The general market setup right now, I think that the fear gauge is through the roof. The incoming calls that I have had over the last day, of the 13 inbound calls yesterday, 10 of them were other advisors going, "What do I do? You spent all this time in the hedge fund space. I just don't know what to do." So I think that the Fed has arguably no credibility left, right? A month ago, the Fed was going 75 basis points. Ha ha, that's not a possibility. And then there was the leak on Tuesday to the Wall Street Journal about 0.75% being a possibility. And you know what happened, right? And that's all priced in. So the question now is, are we going to have some level of reprieve on the supply side inflation? And I'll tell you in 6 to 12 months, Cynthia. Right? Here's Bob with the weather. Right? There's a palpable concern among the investing public. I have not had any panicked calls yet. We are very proactive in our communication with clients, and I try to keep it really, really simple in explaining monetary policy, specifically what quantitative easing is and how that process started March 9th-ish of 2009, and the mechanisms of that, and what the Federal Reserve is doing right now to try and kill demand for what ultimately is a supply side inflationary pressure. And the conversations have ranged from equities to stocks to hedging to what strategies should we be implementing right now from an estate or tax planning perspective to take advantage of this market. So I am long coffee and short sleep, and so far that has been the winning trade.
David, go for it.
Yeah, I think some of the fear you're seeing is, if you look at the numbers, a 60-40 portfolio is down pretty much where it was in 2008 because of the bond side, right? So I'm going to ask you a very simple question that I think is actually kind of mean, because it's not that simple in today's world, but like, you have a client in distribution, ag is down 12.5%.
Yep.
What are those phone calls like? And what do you tell them? And what are your thoughts for their perspective, right? Because that's
sure.
The vast majority of the people investing today.
Well, and the majority of our clients are in retirement, right? And they remember 2008, and they remember the .com era. And the conversations, I just addressed the elephant in the room, which is performance. I go, hey, first and foremost, do we have enough cash to satisfy living needs over the next year or two? And generally, the answer there is yes. So, okay, we have that concern off the table, because we don't want to dive into pulling money out when the market is down. Sequence of returns risk is in fact real, and we want to address that. Then I focus on if it's a 60-40 portfolio, the bond component. I go, the ag is down 12.5%. So if we take a 60-40, 60 stock, 40 bond portfolio, and we look at what that portfolio theoretically would do when equities are down 20, if bonds were working, the performance would be different than what it is now. And we talk about the things that we did late last year to kind of shorten duration, and the outlook on the interest rate market looking forward. And clients understand, right? We go, look, the perceived sleep at night index, this bond index, is down. It is the worst year in bonds that any of our clients have experienced. And we just try to paint that picture. We do use some hedging strategies. We talk about how those have helped the portfolio against downside vol. And we just take it client by client. But they're not uncomfortable conversations. Many of our conversations, we talk about family legacy, family unity, family heritage statement. How do we keep as much money in the estate as possible? Because in an environment like we've had the last 13 years, when the Federal Reserve is serving as backstop, and the Fed put has been in place, and liquidity has been awash in the system, we can focus on those things. So we just address it right off the bat and lay out the different possibilities that could evolve and the actions that we'll take based on those things.
So do you find, I was reading recently from another advisor who was saying that, and this is from during the ETF conferences that have happened earlier this year, but just that for the first time in many years, they're starting to see clients willing to step outside of the types of investments they're really comfortable with, your kind of core vanilla stuff, and really be willing to actually take the time and dab into the more alternatives, whatever those alternatives are, because really just everybody's baffled for what is working in a market when nothing seems to be working. Do you find that to be the case, that there's an opportunity here for some of these other parts of the market that, your average client tends to overlook?
Yeah, there's a newfound interest in alternative investments, and I spent 10 years in that space. Due diligence is absolutely key when it comes to alternatives. I remember, take managed futures, for example, and I'm not suggesting people go out and invest in this. This is not investment advice. Let me hedge that for the attorneys that will watch this and go, good thing you said that. But there would be a run up in managed futures performance. And what would happen? So many of those advisors I'll just pick on 2008. In 2007, hey, I'm Vance. I think that you might want to hedge portfolios, diversification, downside risk, and we're going to have non-correlation, et cetera, and put yourself back in 2007. So many of them told me to go pound sand. And those same advisors, Cynthia, were the ones calling me in mid-2009, begging me to come in. We really want you to come in and present to our clients. We'd love to be a strategic partner. And can you buy a steak dinner? Right? And when they would roll client money into a strategy that had just performed really well in the context of a market meltdown, 6 to 12 months later, they're going, this stuff never works. And I'm going, well, if you put the seatbelt on after a crash, does the seatbelt ever work? And I'm not making a case for Altier. I'm just saying due diligence is key, because it's really important to not performance chase after, you know, an environment that we've seen. Trends have been really strong. Look at crude, look at rates, look at stocks. And it's just really important to understand what's going on under the hood in that portfolio.
So can I ask Vance the mystery question?
Oh,
so
boy.
Vance, yeah, this is, so you're, the thing that's really bugged me over the last 15 years, and I think it's bugged a lot of people, is why have family offices not embraced ETFs as frankly they should have, right? You know, what's going to be the catalyst to get family offices? I mean, they're involved with Vanguard funds, they're involved with State Street, you know, real, you know, simple strategies. But why haven't they? You were talking about alternatives. Shoot, an alternative wrapped in an ETF is tax efficient. Why is that not better?
Oh, yeah. When you say ETFs, do you mean very hyper specific sector ETFs, or just ETFs writ large?
Well, I think ETF family offices own, you know, very plain vanilla ETF. So they just, you know, I need some S&P exposure done. But they don't seem to be looking at ETFs as structural solutions to their problems.
I see. One could be hesitation because of lack of familiarity with how it works. One of the key takeaways that I have from Exchange and from Inside ETFs is, I mean, you walk through these great big conference rooms, and the number of very specific sector specific ETFs that are out there, it's just fascinating. I was talking with Phil Bach about this earlier. Phil is one of my go-to guys in the ETF world. I love him. He's great. And we were just talking about how hyper specific it can be. And there's a level of due diligence that these family offices need to satisfy. Two, it might be a situation where the investment policy statement for a family doesn't allow that. Three, they might be so big that, let's say you have an ETF that has 100 million. Well, if you're going to roll 20 or 30 million to it, you don't want to be the
Sure.
ETF in many cases, right? But the ETF world it's so kind of funny to me to be here talking about this, because I come from the hedge fund space where fees were commonly 2 and 20 to the manager and 1% for an access fee plus the advisor's fee. You're talking 4 and 20, and people would buy that all day long back in 2008, 9, and 10, right? And then you had this huge consolidation and fee compression in the industry, and you hear fees like that and you go, who would pay for that? And it's all relative, right? So at the Exchange conference, I interviewed the head of US wealth management for BlackRock, and very specifically talked about how this environment right now, when equities and bonds are down, this is an environment where you can take a mutual fund vehicle, open up the hood, look at what's underneath that hood, and you can go and recreate virtually the same thing in an ETF. Sometimes one ETF, it might take 2 or 3, but you can go from theoretically, 0.85 or 0.9%, call it, 85 or 90 basis points on a mutual fund that kicks off a huge capital gains tax drag that I see on the client Schedule D. And in an environment like this, convert the average cost basis as it shows up on the statement to a tax lot specific cost basis. So, for example, you have an advisor that puts a growth stock fund, a mutual fund, into a client's portfolio in 2010. If they reinvest the capital gains and dividends each year, each one of those reinvestments is its own tax lot. How is that reported on the statement? Well, it's just reported as an average cost basis. We use a software that will convert that average cost basis, Dan, to a tax lot specific cost basis, where I can go in and I can see which tax lots are down. Well, if you have a $250,000 position, or if you have $1 million portfolio that's full of these types of investments, you can go and sell those tax lots that are down. You have to be really careful and watch out for wash sale rules. And that's a separate conversation, or maybe this or whatever. But if you have the acumen, you can exit out of those, harvest the loss, maybe offset that loss with an equal gain so that you have a tax neutral event, but you create all this liquidity and then you can recreate that allocation at a much lower cost, much more tax efficient portfolio. And I thank you for bringing that up, because that's a way to bring substantive value to the investing public. Because if you look at the cost on a portfolio like that with the tax drag over decades, and you reduce both of those, the amount of money that you can save that client is quite substantial over that amount of time.
And Vance, my last point on this, there are some family offices who also use the expense as a deduction in an ETF. It may be a small amount, but well, if you can write off 10 bips, write it off.
Yeah, many of us miss the prior tax code because the advisory cost that was in excess of 2% of AGI was a line item deduction. And under TCJA, that's not there. But we'll see if that comes back when the TCJA sunsets December 31st of 2025.
I think if there's one thing that's definitive for 2022, it's going to be really the death of mutual funds, right? I think, as we talked about, these balanced portfolios underperforming, but also like flows, I think will follow. American funds specifically started paying capital gains mid-year capital gains to get ahead of it, right? So their portfolios are down. In fact, it's down 12.5. Their portfolios are down somewhere between, let's call it like 12 and 30. And they're like, hey, client, so we're going to distribute 6.5% in capital gains on June 15th. Like, thank you.
Wait a minute, David. Wait a minute. Are you telling me that when a mutual fund is down, a capital gain could be distributed to the client like in 2018?
Yeah, well, but was 2018, but it's never been as harsh as this year, right? It's never been at such an impactful moment in their in drawdown of their assets, as we talked about. This being just as, unless your clients are super aggressive, this is almost 2008 territory for your clients in many ways, right? From an index perspective, like it's pretty bad.
It has been risk off, and the challenge is that there has been nowhere really to hide. You stay in cash for a long time, you lose to inflation. A lot of clients have gone, why hasn't gold gone up? Well, because we haven't really had demand-driven inflation. It's been supply-side-driven inflation. That's a whole separate conversation. And there's just been nowhere to hide. So the conversation is focused largely around how to lose or try to lose less in an environment like this, when the things that have made money in an environment like this would make any compliance department, have elevated blood pressure. And I think, quite frankly, are outside of the risk spectrum for most retail investors.
But so in the very near term, post Fed yesterday, we don't get another CPI read until, is it like July 13th, I think? So what happens between now and then? I mean, literally in the immediate term, is it just going to be more crazy down days tested by short up days, back to down days, or what happens now until we have another sign of whether anything has worked to slow down inflation?
I think much of the community is myopically reading the tea leaves, trying to find any hint whatsoever as to what inflation will do. I imagine there's a lot of prayer going on at the Federal Reserve right now. Maybe they have a prayer session at the Eccles building. I don't know, but I could make a case either way. I don't have real-time transparent data into what's happening with CPI. And if we strip out energy and food, that number is much lower. I've had a lot of clients ask, well, why doesn't the administration just open up the spigot here? Because we have more oil in the earth than we know what to do with. And I go, oh, maybe you should write them. I can't answer that question. But there's been a lot of pricing in of these moves thus far. I wouldn't be surprised if we see more volatility. That's nothing new, right? Everyone on this call and everyone watching this, might be going, tell me something I don't know, but maybe we have a bear market rally. I mean, it really is anyone's guess. I try to avoid forecasting. Even many of the economists that I know explain how difficult that can be. And I just think that if we have a proper asset allocation, unless there's been a material change in someone's true investment objective or risk tolerance, we have two options to play here. One is, buckle up, sit down, using the happy hour metaphor, and I fly a lot. I travel to visit all of our clients around the country. If we're flying and the plane's bumpy, if the flight attendants are still up and about the cabin, maybe order 6 Coronas, put the seatbelt on tight, and just understand that it can get really, really bumpy. It doesn't mean, go out to the door and open the thing and jump out. Come on. The other option is, if it's changed, wait for opportunities in the market where you might have a bear market rally in stocks or bonds, and use that as an opportunity to wait for the market to come back to you to take action. I think there was a comment there that we haven't had maximum capitulation. If we look at the trading volume, we haven't seen a lot of the volume that we have in historical sell-offs. But you know what, Cynthia, that's a great question. I'll tell you in 3 to 6 months. Oh, wait, I mean 30 days, pardon me.
Yeah. And to that point, just to like yesterday I was reading, Data Track, Nick Colas's group, they put a ton of really interesting data points out every day. And he put a stat yesterday that said the market at the S&P 500 has been trading plus or minus 1% every other day this year, where typically on average that happens once a week. And in past times of turmoil, when the market hits what he called, peak volatilities, when you find that bottom and then recover. But the key is that there has to be very low uncertainty in the market, which is not the case right now. There's too much uncertainty for this level of volatility to be suggesting that we're nearing any kind of a bottom. So I guess the point is, we're all looking for, where does this stop? Where does capitulation happen? But it still looks pretty cloudy.
Well, I've had a lot of clients ask questions about this environment relative to COVID, the onset of COVID. And I remember I was at a destination wedding in Hawaii, turn on the TV, and the market's like up 9, down 12, down 11. I mean, there were these massive moves. But the conversations during the COVID sell-off focused around, how are you? How's the family? Are you safe? Are you okay? Things were so volatile that unless people were really trained in institutional trading, retail traders typically were not going in and trading that environment unless they have some experience. This environment is different because, as you're looking at me, it's been this ratchet down, a couple bear market rallies. Bear markets happen. Most of the families that we serve have been through multiple bear markets. The difference, though, on the heels of the Federal Reserve pumping all of the money in through QE, and Congress pumping all the money in through, the STEMI checks, people have gotten used to the Fed put. They've gotten used to low vol. Remember 2017 volatility? It was tiny. It was so quiet. Then we had Volmageddon, and my view is that we are in a paradigm shift. We are entering into a true inflationary regime. I realize that it's supply side driven, but many of the people managing money today have not managed money back in the late 70s, right? And we're just experiencing a lot of uncertainty, and I expect to see more volatility.
So given the reference to the 70s, like given where we are from a demographics perspective and percentage of the workforce, and we don't have women entering the workforce in masses like we did back then. Like how does that play out longer term, right? We talked about this a little bit before the show, but like outside of food and energy, how does inflation really at least partially not become transitory? And you can answer that. Or like, what do you really think the Fed's going to get you on short-term rates by the end of the year? I think you alluded to them having some concern with some influence by politics and, midterm elections coming up. Like at some point, what percentage of the Fed put reappears? And
my view is that demographics are destiny, right? We have an aging population. Based on the data that I have reviewed and all publicly available, the population seems to have plateaued and will come down over the next 20 to 25 years. What does that mean? fewer people to do work. And that is a case where we could see elevated inflation relative to this Fed's target of 2%. I mean, come on. So I wouldn't be surprised if we have elevated inflation relative to the regime, if you will, or the paradigm that we've been in over the last decade to call it 13 years. And we'll just have to wait and see. And from a portfolio management standpoint, you know, we were talking about a 60-40 portfolio, how you allocate that 60% to stocks. Maybe we don't have the growth environment that we did, but this is something that's coming up, David, in a lot of client conversations. They go, okay, we understand monetary policy. We understand that the Fed is trying to use monetary policy to kill demand for what ultimately is a supply side problem. But at some point, if they hike us into recession, they would theoretically have to turn around and start cutting rates. My mom asked me this question. My mom goes, I don't even know what you do for a living, a bunch of math stuff. You hang out with a bunch of economic nerds. It's all really boring. Boo, right? But even she asked me on Monday this week, she goes, why would the Fed hike to then just cut rates again? It almost seems like they're just forcing us potentially into recession. I go, well, because they're trying to really kill this demand. And the Fed could raise rates to 10% tomorrow, God forbid. But is that going to force China to fully open its ports? Is that going to force Putin to get out of Ukraine? It's going to take some time. So I don't know when the Fed put is. David, I really wish you did, and you could tell me and everyone watching this right now, like, where is the Fed put? Jerome, where are you at, right? Give me 7 more of these things. I don't know. And that's the frustrating part. We don't know what the threshold is. And that's the uncertainty that Cynthia is talking about. And so, go ahead.
Yeah, so your point's right. I don't think the Fed knows. So I've got a couple of questions from the audience. Mike Maglio, do you want to ask the question, or you want me to ask your questions?
Bring him up.
Okay, unmute.
All right.
There you go, Mike.
Sure.
Bring him home.
How you doing, Vance?
You know, I'm thankful for all my high-level problems in life, Mike. How are you?
Good, good. So just a couple of quick questions about your practice itself. So do you use any particular products that the average advisor doesn't use? Anything that's exotic or something out there?
Great question. The answer is most of our stuff is pretty straightforward in the context of product lineups. There's one hedging position, and my attorneys were like, you really can't tell them specifically what you use because someone in the public might actually take that as investment advice and they might trade on it. And I'm going, okay, whatever. But meanwhile, anyone on Twitter can tweet whatever they want. And I'm happy to answer specific questions individually. But we do have a hedging position that historically has had equity-like return with bond-like volatility. It's been really the only ballast in the portfolio. And we have that at different percentages in different portfolios. I really try to avoid esoteric, very expensive, illiquid stuff. Why? Well, a few reasons. One, the system has been awash in liquidity. Two, it's a difficult conversation. And I used to see these when advisors had tried certain types of alternative investments that went very, very badly, right? And they would tell me commonly, I tried alts before, it was this particular type of strategy, or it was this illiquid approach to accessing this return beta, whatever it was. And, you know, the clients lost double-digit percentages, or in some cases, a lot more than that, right? We're talking the majority of the position. And I don't want to have those level of difficult conversations. So I just go, what's liquid? Because sometimes in life, it doesn't matter what you own. It matters who else owns it and what they're doing with it. But one alternative, and I'm not active or passive. I like both. If I'm going to access a particular return stream or sector, how I access that is largely driven based on the client's tax return and the type of account that it is. And I look at the historical data. For example, let's say I want to access international investments, maybe emerging markets or large cap, developed equities outside the US. What's the historical return profile for a 40 Act mutual fund versus an ETF? And is there any alpha historically with that mutual fund relative to the ETF? Because I can say, well, you know what? I just want low cost. Cool. But if there's an active manager that historically has been able to outperform an index in a particular part of the world, we all know at this point that consistently outperforming the S&P 500 over very long periods of time is very difficult to do, right? And when we look at certain sectors or different parts of the world, if active, despite its additional cost, has provided historical alpha, particularly in a retirement account, we'll use that. We really have to be careful with the tax implications of using tax inefficient 40 Act funds for clients that are in really high tax brackets.
Do you use any structured products?
I do not.
Okay. And do you have a CPA or attorney on your staff as part of your family office?
So we use the CPAs and attorneys of clients, or what will happen is, this is very commonly the case, I'll explain to the clients that we look at the tax returns, and a lot of the CPAs and
go till 8 o'clock on the weekends, or leave it as it is.
What do you suggest?
I think you should leave it as it is.
Okay.
Yeah.
So we'll look at the tax returns, and we will work with the CPA. Many of the CPAs are reactive, and I don't mean that as a knock, but many of the families go, hey, our CPA asks us for the data. They use Lacert or whatever program they use, and they spit out a tax return. There's really no proactive planning. So when we sit down, we look at the current year and future years tax projections, any events, liquidity events, any changes in income, et cetera, et cetera, et cetera. And if they don't have a CPA who really understands advanced planning, what do I mean by advanced planning? Intentionally defective grantor trusts, irrevocable life insurance trusts, spousal lifetime access trusts, charitable remainder trusts. We will often introduce the idea of a QPERT, or qualified personal residence trust. Many of these are advanced estate planning strategies, and we'll often have to bring in a CPA and or estate planner that has expertise in those areas.
Thank you.
Thank you. And if you hit me up on LinkedIn, we could talk offline. Looking forward to it.
Sure.
Hey, Warren Kaplan, do you want to ask a question? No? Okay, we'll keep you muted then. Let's see, Eric Connolly, did you have a question? You're always good for a question, my man.
Yeah, I've noticed that consumer confidence numbers are pretty low across the board. Is that also the attitude of the ultra high net worth folks that you work with, Vance?
Yes, right. There's this belief that, and by the way, Eric, where are you right now?
I'm on a boat in Boston Harbor, a ferry.
I mean, you want to trade places, bro? I want to be on a boat in Boston Harbor. You got a cigar and a cocktail?
Vance, just so you know, every week we ask Eric, where is Eric this week? He leads the best life. So yes.
The sentiment is just awful out there, right? Our clients that still own businesses are explaining to us that things are delayed. My goodness gracious, the amount of human resources challenges there are out there. It's amazing. When you pump the system full of money, people can do a thing called resign, right? Because they're awash in liquidity. The great resignation is real. Many of the families that we serve are having staffing issues because people are just leaving because they can. It's not that they're necessarily unhappy in their job, but they might not necessarily need the job, right? So the pessimism is real. The fear is real. It's, if I work with a family that has $1 million liquid or 25 liquid, or some that are very, very high in liquidity, the dollar amount doesn't matter. The pessimism is real, and people are worried about markets. They're worried about the economy. They are worried about, everywhere they turn in society to exchange fiat currency for, goods or services, it's going up. And I was recently at an entrepreneurs organization, or EO, event where the business owners were going, we all have to raise our prices now because our costs are going up. We're all feeling it. I have yet to see a financial advisor on Twitter go, I'm raising my fee from 1% to 2% because of inflation. I can imagine the storm that would create. And thanks for getting the humor.
That's not very funny, Vance. That's
yuck. Well,
So what kind of assumptions are you making, actually? What assumptions are you making in your planning on inflation over the next coming years? I mean, we've gone from none to maybe 2. Are you making it 4?
Higher than average. So, and again, I'm not a prognosticator, and
No, you're not, but you have to do planning.
Yeah. Oh, absolutely.
Inflation's part of the
without
plan.
question. We have updated the models to assume that through the end of this year, inflation should level out roughly around 6.5%, somewhere around 4%. I like to assume worst case, generally speaking, and my wife will confirm that, right? And anything less than worst case seems a little more palatable. But we are updating the inflation inputs into the financial plans that we do, which are typically 40 to 85 or 100 pages, to really account for the increased elevated inflation that we have experienced.
So we talked a little bit before the call. There's, whether it's the consumer index or sentiment, everyone is very bearish. Everything has been very correlated for the most part, or at least vehicles in the public market. If there is this bear market rally, which could be quite strong, like, how do you play it? Right? What area is the best way to capitalize on that? Is it corporate bonds? Is it treasuries? Is it NASDAQ? Is it crypto, right? They've all been correlated. All 4 of those right there have been correlated, right? So how do you, and the way I look at it is, like, you could probably do 2 of them. And honestly, bonds might start actually protecting if there's another further leg down, right? So finding like a bull case between them and a bear case between if that correlation breaks, which we've seen this year. Like, what are your thoughts on that?
Yet diversification has largely been dead this year because we've had a beta of 1. Clients that watch this will go, what does beta of 1 mean? It means that asset classes that have historically behaved independently of one another, or not had correlation, have been very highly correlated, not just stocks and bonds, but across the board. I wouldn't make very specific sector bets, if you will, because we really look at the investment policy statement for a particular account or for the broader family, and we'll allocate across that on a pro rata percentage based on the IPS. I am telling clients, if you can fully fund your 401k, your retirement accounts, etc., do that, because this too shall pass. And as I mentioned earlier, many of the families that we serve have been through bear markets. And what do people think about when they think of bear market? They think of 2008 and they think of the .com. The sort of plain vanilla bear markets, you go back to October of 2019, when the S&P was down 19 point something percent, didn't fully hit 20. Steve Mnuchin comes out on a Sunday night. He was in Mexico and he's like, hey, I talked to the 6 largest banks. They're all flush with liquidity. No reason to worry. And we're going, it's the Sunday before Christmas. We weren't worried, Steve. What should we be worried about? And then from there, the market recovered. I'm confident that in due time, this too shall pass. But we don't have a Fed put. Ostensibly, quantitative easing is not there. But you've asked a very specific question about a bear market rally, right? I would think that in a risk on environment, you can leverage ETFs, meaning deploy into ETFs, to capture that upside.
Yeah, we sorry, Dan, I'm going a little bit out of order. We don't have a Fed put, but it's not 2008. The banks aren't closing. The VCs and private equity firms learned and structured these 3 to 5 year windows where as long as this doesn't exist for like 3 to 5 years, they're probably okay, and they can keep deploying capital. Quite frankly, the only ones that can really deploy a lot of capital off of the bank's balance sheet, right? Let's call spade a spade. They're the ones that get the best access to that. Your clients' businesses, are they closing, or are they just like, are their profits down? I feel like everything seems very, very overly bearish in the short term. I've never seen so much conviction when, like, yes, margins are down, but like there's still business. I don't know. Maybe I'm being naive.
No, businesses are not closing. In fact, we have a family that has a pending liquidity event of substantive size. And, you would think, okay, if there's that much pessimism, why is the liquidity event still happening? Business is still going on. It's just things are costing more. What happens? How do they operate? Do they go, oh, well, our expenses are up 15%. We'll just knock that off of our profit margin. No, they roll the price to the consumer. And that's the pain that so many of us are feeling, at the pump and at the register. But I have not had clients with businesses that have closed. I have had clients leave states like California because they're going, I just can't take it anymore. But no businesses have closed.
On that front, like a lot of these no income tax states in Puerto Rico where people were hiding or moving a lot of their gains, like that's going to be a dicey real estate market for a little bit right here.
I thought all Californians are going to Texas and Florida.
Now they can go back though, lower cost basis.
Yeah.
What are you thinking?
Other questions?
What are you thinking about real estate? Because I got to tell you, I'm hearing real estate prices, particularly rentals in New York, are going to rip on the up, which candidly makes 0 sense to me. I mean, New York should be cratering in terms of real estate.
What depends on
advice.
Yeah, I mean,
not investment advice.
It depends on the sector within real estate, right? If we're talking residential housing, first and foremost, check out Zelman and Associates, right? That's my go-to. But if we're talking residential housing, I bought a house in Texas outside of Dallas because my wife's family all lives in North Dallas. And she's going, look, you travel all the time. We have 2 very young kids and we have no family or support in California. So I want to spend time with my family. We were there, enough where I'm going, man, places are cheap in Dallas at the time, right? I got a 2.5% 30-year fixed mortgage. This is before the big run up in prices. This is before all the people started moving to Dallas, Texas. I literally can't sell that house, right? Because the joke would be on me. I go from a 2.5% to what's a 30-year fixed is 6 something percent today. How many people who moved or refinanced in the last 2 years are in that cohort? I don't know that number, but I imagine it's a lot, right?
And so just had the average life of like people living in their home has actually been extending over time. And what you're saying right here is that this locks them in further and that trend continues, right?
That's right. That's right. So you look at the affordability of housing, if I'm a millennial, one of the many reasons I'm angry right now is because I can't afford it, right? Think about the cost of housing relative to what many folks in that cohort actually make. And it's deeply frustrating. So I've gotten a lot of questions like, do you see the 2008 housing crash coming again? Theoretically, anything is possible, right? Because the compliance attorneys are going to watch this, but the system isn't levered as much. You have way more demand for residential housing than you have current supply. And think about it. People aren't going, you know what? I really, really want to move to another place, get out of my very cheap, affordable mortgage payment, pay way more. Or, I saw this interesting anecdote on Twitter. I forget the exact numbers, but if you have a 2.5% 30-year fixed mortgage on like a $600,000 house, there's a payment there. Well, that same payment at 6% would get you a $350,000, $380 something thousand dollar house. Who's going to downgrade? It just doesn't make sense, right? So if we're talking residential housing, I've said what, my thoughts are there. If we're talking, office buildings, right? A lot of people still don't want to come back to the office. Who wants to commute 30 minutes to 90 minutes each way? I don't care how good the podcasts are, right? Who wants to take years off their life sitting in traffic with a bunch of people who are just driving and staring at their cell phone anyway? Like, this is our species. It's just fascinating to me. People want to work from home, right? So, and I'm one of them. It's great. But then again, I live out of a suitcase. So I love my hometown.
And to that point, before you continue, David, I was just going to say, I just read on Twitter today, somebody made the statement of, for most people, a decade of really high mortgage rates is way worse than a decade of really low equity yields. So it's just kind of fascinating. We're so obsessed with the market, but in truth, the real pain is in this real estate market.
I saw the same tweet, Cynthia.
I know we follow the same people.
Yeah,
so cool like that.
Yeah, including Danielle DiMartino. By the way, I leave this book here so that when I'm on Zoom meetings with clients, and all clients know who Danielle DiMartino is, they get a copy of Fed Up, and I tell them, read this, understand monetary policy, understand what the Federal Reserve is and what it's supposed to do. I think when most people hear that the Fed's dual mandate is full employment and at prices, they mistakenly think that it's elevating equity prices, right? Based on the last decade. But it's, we follow the same people. Question.
Last question, just from a larger scale. So I think the global real estate market is somewhere between like $700 and $750 trillion. Global equities is like 100 to 120. And crypto is like 1 or lower right now. How do you advise or don't advise clients on the crypto side of allocations? And what are your thoughts right now?
Oh, well, one, I can't because it's not an actual SEC approved investment, right? Meanwhile, my Uber drivers, bartenders, everyone's talking about it. But it hasn't been approved by the SEC. And because I use a corporate RIA, because 7 years ago when I had literally 0 assets and 0 clients, my good friend Wayne Bloom, who's the CEO of Commonwealth, was like, hey, we'll take you. You meet none of our requirements, but we've known you for years. And I use Commonwealth's corporate RIA. And because of the way the regulations are, I can't comment publicly or advise clients on crypto. It does come up in conversation. A lot of questions are coming up around why is crypto tanking? Because the narrative was crypto is supposed to be a hedge, right? But we've had all assets, largely almost all assets, moving in unison, and that direction has overall been down. So that's it on the crypto space. I never really jumped on the crypto bandwagon because if I'm the Federal Reserve or if I'm the central bank of any country, what is my largest threat? Decentralization. I would think that the Fed or the ECB or the BOJ or whatever would come up with their equivalent just to retain the control and try to have an electronic, version of fiat, more or less. I think that most folks don't understand the true technological fascination and capacity of the blockchain. It is just fascinating. As a currency, I wouldn't want my currency going up or down by 40%. No thanks, right? As a technology, fascinating. Not an endorsement to go out and put money into it, by the way, but I have to say that, and all of you know why.
Oh, I've put money into it for the first time about 2 months ago. So you know how that has gone. It's been possibly the worst investment I've ever made, but learning a lot, I guess. So Vance, we're getting ready to.
It was $50. Relax.
Hey, Dan,
I'd
you know
be
what?
losing a day. Yes.
Dan, I remember I was at a hedge fund conference in 2010. Maybe it was 2011. Now I sound like my parents, right? Does it really matter what year? Anyway, it was a while ago. And this hedge fund manager got up on stage and he goes, all of you should take $10,000 right now and just go buy it. It was 50 cents at the time. And you think about that, right? And you go, oh, it could be worth whatever. What do most people do? You get a 400 or 500%, or maybe a 10 bagger, right? You get 1,000% return. You sell out of it. You're like, woohoo, like, right? Because that's how people think, right? That's the behavioral psychology. It's just been so interesting to watch. And sometimes we get into things, and the timing is unfortunate, but we'll see how things go.
So as we wrap up here, Vance, I just wanted to finish by asking, we constantly talk to advisors and just the constant conversation about the value of advice in the changing world of financial advice. So is this the best of times to be a fiduciary or the worst of times to be a fiduciary in terms of really proving and delivering your value proposition to clients? How do you?
My view is it is 100% the best of times, right? So many folks go, oh, accounts are down. It must be so hard to have those conversations. No, call clients, tell them why, explain to them. You got to explain it in a way, like organic chemistry, by the way, Cynthia, was my favorite class in college. I loved it. There's like 40 rules. And if you can turn things around in 3D in your mind, it's super easy for some folks. And I loved it. But to take a complex subject matter and then teach it was something that I learned back then, because I used to teach, kids in college on how this stuff works and biochem and other things. Anyway, it's so fascinating that all these years later, taking things like an inverted yield curve, right? Or gamma trades, right? Or things that are happening right now that are germane to this market environment, and introducing it in a way that, the average client can understand. There's a bond that's formed there, and explaining what's happening and why, and understanding the mechanisms of formation, it brings a level of ease. But right now is the time where much of the advice can become so intangibly valuable. There are certain strategies to implement when markets are down. For example, let's say a family has a concentrated stock, right? And that concentrated stock is down substantively. Well, maybe, just maybe, they should consider using part of their lifetime exemption to transfer that stock if they think it's going to go back up in value. Because if I have a stock that's worth this and then the market erodes it to here, I can use part of my lifetime exemption to irrevocably give that to various different types of trusts, or maybe a family member or whatever. But there are things that we want to do when valuations are down. Or I mentioned earlier about the strategy where you take a tax inefficient, very expensive mutual fund-based portfolio. It's not a knock against mutual funds, but if I open up the hood and I look at what's under there, and I can tax efficiently exit that and get the same allocation with an ETF or multiple ETFs, right? It's something to consider, because so many of us are taught, when the market's down, don't have a knee-jerk reaction. When the market's down, don't run for the hills. And I've had clients tell me, well, yeah, but my former advisor, and many of our families had advisors for 20 to 30 plus years, some cases 50 years. And we're hired at a flat cost initially to do a deep dive into the full estate. We look at all of the things that involve dollar signs in the estate, and we advise them on the strategies that they don't have and things that could be done to really bring a lot of tangible value, not only on the investments, but also on the planning side, largely in advanced planning, because a lot of folks in our industry don't have specific expertise in that advanced planning. That's where so much of the value is. And at Inside ETFs, I hosted the Alpha of Advice panel, where we talked specifically about how to quantify the value of your advice. Because if we can help a family minimize, if not avoid, an estate tax, right? Especially after the sunsetting of the Tax Cuts and Jobs Act, how do you value that, right? If you have an estate that's going to have a $2 million or $5 million or $20 million estate tax, and you can solve that problem, clients typically are not going to complain about any fees. One of the things that I wish I had learned sooner in this industry is establishing a retainer like an attorney, but way warmer and fuzzier, so that we are on retainer. And what I found is that when we're on retainer, people provide us all the documents that we want so that we can do the deep dive. And it just really gets things into gear. Roth conversions, right? If you look at the income of many people who transition into retirement, they retire, their income drops, and there's a period of time, and then Social Security kicks in. For many people that can wait until 70, that's the best thing to do. In that valley, right, where the taxable income goes down, you can do Roth conversions. Well, account values are down. So if someone's transitioning into retirement this year, and we have a family in Texas that's coming on board, their AGI is going to drop significantly. So in fact, that person retires at the end of this month. We've already figured out how much of their retirement accounts we can convert to still stay in the current tax bracket, and how much over the next 5 years we can convert to stay in the 22 or 24% lower tax bracket. I don't think a lot of people, Cynthia, have really caught on to the fact that under the Secure Act, non-spousal heirs of IRA accounts have, unless they meet certain very select criteria, they have 10 years within which to take all that money out. That's taxed as ordinary income, right? So a lot of folks that have a $1 million or $2 million or $3 million IRA go, wait a minute, all my kids, they're married, they're filing jointly, they're making, an income high enough where they're in the 30-something% tax bracket. They're in a state like California or New York, you add this, or Maryland, you add the state income tax, you could very easily be at 50%. I don't want all of my retirement assets going 50% to taxes. How do we solve for that? So this is without question a difficult environment because of what's going on with stocks and bonds, but it's an environment where we can really focus on bringing tangible value through advice.
Well, I hate to admit it, but organic chemistry was definitely not my thing. So I'm glad it was for some. So I think we'll be wrapping up. Vance, I wanted to thank you so much for taking the time, come on the show, talk to us. It's always so great to see you and hear all your insights and how you see the world. Always so much to learn.
And thank you for having me very much.
And thanks to everybody for joining us. It's great to see your faces. It's great to be together again. And we look forward to show next week. We don't know yet who the guest is next week, but we'll sure let you know. Maybe, I don't know if you know, Dan, I don't know who the show is next week. So,
you find it.
Always a pleasure. Yeah, we're a little bit of an improv show sometimes. So always a pleasure. Thanks for joining us and have a great weekend.
Thank you.
Thank you very much.
Everybody.
Thank you.
Bye.
Bye.